Let's drill down on two of those Mag 7 names selling off after yesterday's disappointing second quarter results. Tesla down 10%, as we mentioned, on that earnings miss caused by shrinking auto sales margins, while Google parent Alphabet down more than 4% as ad revenue came in below expectations. Here to talk Tesla is George Gianarikas. He's senior analyst at Sustainable Energy and Mobility in Canoccord. And for all things ads, we have Mark Douglas, CEO of Mountain. Welcome to you both. George, first to you. Why do you think the sell-off is picking up some steam today?
Well, I think it had to do with exactly what you referred to. Those auto gross margins weren't very good. As a matter of fact, they were down sequentially. We were expecting up. We were still trying to work through exactly why that happened, particularly when there was an enormous restructuring charge that they took. But our view is that people should be looking forward a little bit here. We have two potentially massive catalysts over the next several months. One includes Robo-Taxi Day on 10/10. Great things expected there. We'll see what they talk about on that date. And finally, we are expecting, and the company confirmed yesterday, new vehicles that are due to be produced in the first half of 2025. So we'll see how long the sell-off lasts. I understand the disappointment around auto gross margin, but we have two very big things happening over the next several months.
Yeah, that said, I mean, there's the big picture with Tesla, then there's kind of the nitty-gritty of how they're going to make money. The company is diversifying from auto, but it's maybe not diversifying yet into profitable areas that could be exciting future concepts like Robo-Taxi.
Yeah, look, I mean, one thing that we were paying very, very close attention to yesterday was the FSD, full self-driving driving take rates. If the more people adopt full self-driving on their traditional Tesla vehicles, the higher their gross margins will get. And I have to say, they've probably been disappointing, those take rates so far. And we think that just because the company didn't give a lot of color around it. In our opinion, either that product has to get a lot better, which is what they're promising, or they have to cut the price again. As a reminder, they cut the price from about $15,000 to $8,000 for that license. We did a survey a couple of months ago that implies that the real sweet spot for FSD is probably around $5,000 based on where the product is today. We'll see if it gets better. Yeah, people are willing to pay more.
I have to imagine, even if they take a little bit on the chin to get wider adoption, that's good for the company in the long run. In the meantime, George, as you look at the NASDAQ more broadly, many of your other coverage area companies are in it. What do you make of the downdraft today?
Look, we've written a note, a series of notes called Something's Got to Give with regards to, look, we don't cover NVIDIA. We don't have an opinion on the stock, but we do cover energy. And it's really fascinating to watch that a lot of the companies that appear to be buying a lot of the H100s, including Tesla, have admitted that they don't have the energy resources to power them. So in our opinion, either the energy resources that are being deployed to power NVIDIA chips really have to pick up steam, or there will be a digestion period of some of these NVIDIA chips in the marketplace. And that's why we call it Something's Got to Give, because one has to be really good or the other one has to go through a digestion period. And maybe, at least with regard to one of those companies, the big one, NVIDIA, the market is starting to pick that up.
Yeah, no, I think that's an interesting point, although wouldn't you say that comment is still bullish in the long run? It's not the narrative of people over-ordered or the AI investment isn't worth it. If the simple problem is powering it, then that's a more bullish observation, I would think, than perhaps the fear, which is, no, maybe it's not worth the money.
Yeah, I think that's right, Kelly. Although, as you can probably tell from the lack of hair in my head, I started my career in 1998 covering technology stocks and specifically telecom equipment. So I remember very clearly that a lot of people spent a lot of money building out the internet, and they were right. The internet is obviously is a very big deal 27 years later. But the problem is that we had to go through this huge digestion period, and that was the dot-com bubble burst. Now, I'm not saying that one is the same as the other, but digestion can prove very difficult when stocks are at the multiples that they are today.
It's such an apt point. You can be right about the power, right about the need, and yet it doesn't make you sort of investable in the short run.